Welcome to Daily Tax Minute. This is Tony Novak here with a few pointers on how to avoid tax trouble. Today's topic is legal ways to avoid self-employment tax or reduce self-employment tax. And this stems from the episode 2 days ago where I listed a number of popular ways to avoid self-employment tax and pointed out that there is a significant indication that many of them are used improperly and are not legal, and it was more of a warning than a help. So one of my friends online and in real life pointed out that she was hoping to get some real usable tips. So that's what we're going to do today. We're going to talk about 4 ways to reduce self-employment tax. Those are not the only 4, but it's certainly a start, and the intention is to get us thinking along the lines of that type of tax planning. So I have them broken down into 2 that are temporary solutions. In other words, they'll avoid self-employment tax this year, but you might wind up paying it in a future year when your business is more profitable or you sell or whatever. The other 2 are permanent solutions, meaning that once that money flows through the transaction, that's it. It's not going to be subject to additional tax in the future. So let's talk about those. Let's break them down. So the temporary solutions. How do I avoid self-employment tax this year? And here we are. You're coming up into the last month of the year, so it's a common question, not just self-employment tax, but income tax. What can I do in this last month to reduce my tax burden for my business that I own for the year? Well, the most common and most popular way is to grow your business. If you're reinvesting in your business, our tax code is set up to allow most of those expenses to be immediately deductible. And in some cases where you haven't even come close to paying out cash for that, just signing a IOU and taking delivery on a business asset is often enough to generate a large deduction that can reduce or even eliminate your entire self-employment tax. And I'll add right here, we're not talking about whether it's smart to eliminate all of your self-employment tax. We'll save that for another day. But growing your business is certainly one of those. Another temporary way of avoiding or reducing self-employment tax is deferred compensation. And just like the name sounds, there's many creative ways where you can take that money, make it relatively safe, move it away from, so it's not going to be spent in the next month's pile of bills, get it into a safe and growing asset and not pay taxes until sometime in the future. This is a whole world of tax planning all in itself. It happens to be the area that I entered the profession in. My tax law focus and back in law school was compensation planning, and this type of planning was, particularly for professionals, was a big part of it. So that's one way, deferred compensation. I mentioned that there are at least 2 ways to get rid of self-employment tax on a permanent basis. And one is to pay yourself a non in a way that is not considered earned income. There are certain provisions under the tax code, particularly qualified employee benefits. And how I like to think of this is things that you would have paid anyway, but let's just have the company pay them rather than you pay them. We don't have time to go through all of the long list of things, but there's life insurance, health insurance, medical expenses, out-of-pocket expenses, childcare. We can go on. The list, and the list seems to be growing, so that's a good thing. Student loans nowadays, that's something perhaps the newest one of the list. Not everybody can do it, and not in every situation, but it's certainly worth looking into those. And you may know that in one of my past publications is on medical savings account and health savings account. So that was sort of my claim to fame in at least the national speaking in publication many years ago. All right, so in the last area, the fourth thing, how can we reduce self-employment tax on a permanent basis? And now I'm going to draw a blank. What was the fourth one? Give yourself benefits. Oh, wow. This is the disadvantage of doing it live. So here's what I'm going to do. Because I do this every month. I say, if you have a question you want to talk about, get in touch. There is a fourth way. There's at least a fourth. There's actually many ways. I boiled it down to four. I said, if you want to hear more, get in touch, taxproblems.cpa. I'm happy to talk about what's going to fit in your particular situation. Oh, okay. So, of course, that triggered what the memory of what we do want to talk about. So think about your dollars of income coming into your business. If you're the only person that works in the business, we assume that that's all the income as a result of your labor. So that is earned income by definition. But that's not necessarily the case. There are other kinds of incomes that are not earned income and therefore not subject to self-employment tax. The most common example is rent. And we think of rent as being for real estate. It doesn't need to be for real estate. Licensing fees, rent for a piece of equipment, or licensing fees for a bit of software that you created, or some creative work that you've created and you're now leasing out or licensing out for use. That income flows in separately and is not counted as earned income. And so if you can take a look at your income flow, and probably more of us ought to do that. And my business involves a good bit of accounting and subscription services. I probably ought to separate those out and not put them all into the same pool as would be counted towards earned income and self-employment tax. Okay, so I got through the four. There's plenty more. I'm happy to talk about them and which ones may affect you. And I will look forward to being back tomorrow with another Tax Minute.